This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Need help in finding investors for your startup, fund, or angel group? 10 Capital provides funding as a service helping you find accredited investors. Contact 10 Capital to gain access to investors for angel and venture capital funds, family office rounds, and syndication raises. To learn more, go to 10capital.group. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Sam Silvershein, associate at Alpha Partners. Alpha Partners is a next-generation growth equity firm that focuses on accelerating private technology companies. To these companies and their investors, they offer an option to quickly fill out a growth or expansion stage of financing round in a friendly and rational manner. Sam, thank you for joining us.
Hi, Hall. It's great to talk again, and I appreciate the invite on your show. And I do want to give a shout out to your last guest, Ross Darwin, who's a friend of mine and a fantastic ed tech investor, and everybody should go and listen to his episode.
Great. It was a fun one and looking forward to this one as well. So to kick off, we always ask, what's your background before investing in early stage companies? Where did you come
Certainly.
from?
Yeah. So I've had a pretty circuitous background, similar to a couple of your other guests. I attended Dickinson College for undergraduate, where I studied biology with a pre-med track. And I became interested in yeast and fermentation sciences. And so like any good college student who's interested in fermentation sciences, I actually began fermenting and experimenting by fermenting beer under my bed. And then immediately after graduation, I turned that hobby into a full-time job where I started brewing beer in a professional setting. And over the next couple of years, I ended up working my way from an entry-level brewer to the head of production for a chain of brew pubs, where I managed beer production and operations for 8 pubs around Massachusetts. And I helped them open up 2 pubs in the Logan Airport. I then shifted from brewing beer and operations into hospitality and management of a restaurant, where I connected with a restaurant owner in Manhattan who was looking to start his own beer label. I spent my afternoons and evenings managing the restaurant, formulating and producing our beer. We also opened up a steakhouse speakeasy. And then I got to pause here, actually, Hall, because for most of the rest of my background makes sense. I must note that my grandfather was a portfolio manager, and when I was 13, he took me to the floor of the stock exchange back when there was a bunch of activity. People were actually down there, and I got my first exposure to investing. So fast forward, back at the restaurant during my tenure there, I really honed in on the fact that I like to start brands, build companies, work with entrepreneurs, and most of all, invest money. So while at the restaurant, I went back to school, started getting my MBA in finance and operations management, and then COVID hit, and obviously everything changed, especially in New York. So we didn't close for a single day, but I really started to look outside of the restaurant industry. And I was fortunate enough that one of my bartenders who used to work for me also works in venture. And she had turned me on to a summer associate position with Alpha, which I immediately jumped on. And so continued to work at the restaurant, continued to go to school, continued to be a summer associate for Alpha. And I quickly realized that venture was the right next step for me. And as they might say, the rest is history.
Mm-hmm. Well, that's a great path to venture. So what excites you right now?
So there's a lot that excites me. Technology and globalization have had a really market impact on the private markets. But more specifically, I think what excites me is the democratization of the private market and investing in general in this industry. So as many of your listeners may remember, in August of 2020, the SEC amended the definition of an accredited investor, which really expanded who has access to this market. And I think being classified as an accredited investor doesn't mean you're a better investor or have a better understanding of the risks. So I'd like to see them continue to open up this world. We now have platforms such as AngelList, Republic, Seed Invest that are gaining popularity and really lifting the curtain on this previously closed off market. And I think, in addition to providing angels with pre-diligence companies and stronger deal flows, these platforms have lowered the check size required to invest and really eliminated the risk of having to write huge checks and potentially overexpose yourself to the risks that come with the private markets. So for many of these reasons, I'm excited about the changes in this industry. And following that up, I think there is now a diverse range of founders who are gaining exposure and access to this capital. So, for example, in the first half of 2021, companies with all female founders raised more than $2 billion, which was more than all of the funding they had received in 2017. That said, we still have strides, a long way to go, considering that's really only 2% of the VC dollars invested to date have gone to all female founded companies. And so I think the tailwinds are growing, and I think democratization of this industry is going to help with that, but we got a long way to go.
Great. So you see a lot of startups and a lot of investors out there with what you do. What's your advice for people investing in startups? What do you tell them to do before they write the check?
So it's interesting. It's a good question. So where we sit with Alpha, we focus on Series C and later companies. And so investors at this stage are pretty well seasoned. But, I was thinking about it, and I think my first piece of advice, which is pretty identifiable, is to use a benchmark to help triage deals. There's more deals than ever, as I'm sure many of your listeners know. And the shot clock on those deals have really gotten short. I've seen it my 1 year, my 1.5 years here in venture. When I started, we would have 8 weeks sometimes to diligence a deal. And sometimes now we have 6 days. So keeping pace is difficult, and being able to get to a quick no is extremely important. My second piece of advice would be to recommend diversifying investments. As some of your listeners know, about 90% of startups fail, but only 10% of those startups fail within the first year. Meaning the majority of startups will fail within years 2 through 5, also meaning they've raised formal rounds. And because investments in the private market, for the most part, are illiquid, it's important to spread around capital. And so even though there are a lot more unicorns today than ever before, given the amount of liquidity in the market, really only 1% of those startups turn into unicorns. And it's extremely difficult to know who's going to become that unicorn and return your fund multiple times over. My other bit of advice is to really flesh out your diligence process and form a thought out thesis. It's never fun for an investment to fail, and then you go back and kind of do a post-mortem only to uncover red flags that may have been missed because, say, the deal is moving too fast, or there were a lot of great names around the table and you got excited and rushed your diligence process. And then on our end of things, on the growth side, valuations matter, but only to a certain extent. And so as you've seen, valuations are growing. It's hard to justify many of those valuations. But at the same time, we're finding that as liquidity continues to grow, those valuations will continue to be outsized. And if you're not paying, you're not really playing. You can't win.
Great. And then on the other side of that table, what's your advice for startups raising funding? What do you tell the founder to do before they go out to launch that campaign?
Certainly. So I have 2 bits of advice, but I'm going to keep it short because at Alpha's level, we're positioned to be low-touch investors and tend to defer to our early stage partners and leave the advising of companies to them unless some way we can be specifically value added. But I think on the earlier side, there's 2 bits of information or 2 bits of advice that I would give. The first one is for founders to have thick skin. Just because an investor turns down your round doesn't mean they don't like your company and vision. I would ask for feedback and then move on to another investor. Feedback can be extremely valuable from investors that turn you down. You also don't want to have to convince somebody to be on your cap table. It's a long relationship. And if you force them into your business or on the board or on your cap table, it could make for some rocky relationships. And then on that same line, the other bit of advice is to always be flexible and ready to adjust. By the time companies get to our stage, that Series C or later round, we're not seeing the first iteration, the second iteration, or even the third iteration of that business. And that's okay. Have the story, know that you have to pivot. And most investors are really betting on you and your team and your ability to execute rather than your business plan. And then on the growth side, founders that are raising a round, my advice would be to choose your partner and your lead wisely. At Alpha and with many growth investors, we really lean on the quality of the lead while doing diligence. We see it as a strong signal, and it helps us get conviction around an investment. And, Hall, the reasons top tier leads get us excited is called the hot hand effect. And so unlike in the public markets, in the private markets, because top performing venture funds, when they perform well in year one, most likely, more than 50% of the time, they perform well and beat the index in year two. And so that's why top tier leads really gives us confidence that they have done their diligence and the valuations are favorable.
Great. And so let's talk about the state of startup investing. How do you see the industry evolving from here post-COVID?
Yeah, here post-COVID, that's a good question. So recently, there's been a marked increase in early stage funding. In the first quarter of this year, funding for nascent startups topped $39 billion, which was an all-time high. It's up from $22 billion in the first quarter of 2020. And as I previously touched on, this is pushing up valuations and the pace of play is really speeding up. And then along those lines, Greylock just announced a $500 million seed fund, and Dreesen announced a $400 million seed fund. And my expectation is that these larger seed funds are going to start taking a page out of Tired Global's book, which is to write huge checks into the hottest companies. So, for example, in 2012, nearly 50% of all angel and seed deals were 500K or less in size, in round size. Last year, that number dropped to only 25% of the rounds were less than 500K, and the majority of the rounds were actually $1 to $5 million. And this is increasing, and I think this trend is going to continue to increase as more money floods into the earlier rounds. The other major evolution is that companies are staying private longer. And so I'll cherry pick an example for you. In 1999, Jeff Bezos founded Amazon. And in 1997, Amazon went public at $18 a share at a valuation of $300 million, which today would just be unfathomable. Pre-revenue companies can raise with a pre-money valuation of $300 million. If a company says they want to go public at that, nobody would listen to them. In 1990 and in the early 2000s, companies were staying private for about 6 years or less, and then they were going to make their IPO. Today, we're seeing companies stay private for 10, 15 plus years. So what this has resulted in is it's forcing smaller pre-seed and seed investors, people that Alpha partner with, to adjust their fund mandates. And what I mean by that is these early stage VCs are being forced to reserve less follow-on capital for later rounds or take smaller ownership positions when they make an initial investment. And to combat that, traditionally, pre-seed and seed funds have had three options. They can either, one, forego their pro rata, which is their right to invest in future rounds. They can set up and raise a special purpose vehicle, or they can raise for an opportunity fund. And let me quickly break down those three options. If you let your pro rata rights expire, you're leaving returns on the table. There's no way around that. If you want to set up an SPV, this can be difficult given, like I had mentioned prior, deals are moving faster than ever. You might only have 1 week to raise an SPV and take down your allocation. So that's difficult. And then on the third front, it's hard to raise an opportunity fund. If you're, say, a $50 million seed fund, why would an LP give you a larger check for an opportunity fund? It's difficult and time consuming. And so this is where we play. We actually offer a fourth option, which has been pretty lucrative for our early stage partners. And they've leveraged our growth, our capital, our ability to move quickly, our ability to set up SPVs, to exercise their pro rata in growth round deals, stay on the cap table, keep board seats, and retain ownership of companies as they continue to scale.
Great. And so what do you think is the biggest change you'll see in the next 12 to 15 years?
I think it's going to continue on this trend. I think we're already seeing the changes. It might speed up more deal flow, more companies getting funding, higher valuations. And it's really a matter of where the breaking point is. And I'm not a betting man, and I'm not going to make a guess because I'll most likely be wrong. But I think we're going to continue to see these trends for the time being and for probably a while into the future.
Great. Well, let's talk about your investment thesis. What's your criteria for making an investment? What exactly are you looking for?
Yeah. So our fund, for a little more background, we're industry agnostic. We're not geographically constrained, which gives us the ability to move with market trends. But what really gets us excited, as I had mentioned prior, is the quality of the lead. it's hard to do diligence as an industry agnostic investor when you might only have 4, 5, or 6 days. So we really lean on the lead, and we lean on our early stage partners who have been with the companies since they may have been the first check in the majority of the cases. And so given the speed and the valuations of current rounds, we're able to lean on their expertise when diligencing an investment.
And can you mention one or two startups that fit that thesis?
It's a good question. So not really, because it really depends on who raises, who has extra allocation that they source to us. But what we're excited about is really the financial space, fintech, and as I initially touched on, just the democratization of the financial industry and the ability to invest in new sectors. We think globalization, the onboarding of, say, Africa and Latin American infrastructure, any startups that fit into those spaces are really exciting to us.
Great. Well, you see a lot of startups and investors out there and the challenges they face. What's the main challenge you see startups face today?
The main challenge here is going to be picking the right partner. As these top tier funds are raising these larger and larger funds, and they all start moving faster. And you might even be presented with a term sheet before you're ready to raise. You need to get a good grasp on why you're raising money, what it'll mean to bring on a new board member, and what valuation you can really warrant. Because the worst thing you can do is have a really excited investor wanting to preemptively lead your round. You raise at a premium, and you don't grow into it in time before you need to raise your next capital. And if you have to do a down round, it's really bad signal, especially in this market. It might not be an issue with your company. It just may, you may have jumped the gun, but down rounds will put significant pressure on your ability to raise.
Great. And then what do you think is the main challenge the investor faces in today's market?
Similar. So at the growth stage, our capital is mostly additive. But we don't take a proactive role in our investments. And with valuations becoming outsized, deals moving faster, less information, it's difficult to do a deep diligence and really get comfortable with an investment. And you have to trust the other people on the cap table. And for investors at our stage, it's important to try and preempt the rounds the best of your ability, have a deep understanding in the markets that you're looking to invest in, but really trust in the diligence from prior rounds. We love to see, old investment memos, things that we can leverage to get a better understanding of the business, how it's progressed over time, how the team operates, and where it might move into the future.
Great. We see a lot of different applications and sectors out there. If you had to pick one or two that you think are really good opportunities to pursue today, what would you put at the top of the list?
Yeah, Paul, that's interesting. Considering, and I keep going back to the democratization of this industry, the ability for invest in any sector. And so, I recently read an article about defense startups are gaining an interest from investors again. And previously, they really didn't return that much. But you can find any company in any industry, and you can most likely make an investment into that. And so an immediate opportunity for investors to pursue, it really is what interests you. And that's what I love about this industry is there's so many great companies out there, and they might not all succeed. But if you put your trust in a founder and you help them along their way, if they don't succeed with the first idea, they might succeed with the second idea. Apologies for that, work from home life, right? And so I think that's what's interesting. That's what the immediate opportunity is figure out what you're good at and what you like and go and chase it down.
Great. Well, the last few minutes that we have here, what else should we cover that we haven't?
I'm really excited to see how this continues to play out. Something that we continually talk about internally, which again, I've mentioned is these valuations, speed of the rounds, outsized seed rounds, the ability for angels to continually to have more influence over the industry. And so I'm just excited to see how everything plays out over the next couple of years.
Great. Well, how best for listeners to get back in touch with you?
Certainly. So you can go and find me on LinkedIn. My name's Sam Silvershein, should be in the show notes, and I'm pretty responsive on there.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Appreciate it all.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.